All right, let's see. All right, well, to those of you, Carmen and Colton, who joined on time, thank you. So we're just going to go ahead and get started. We have this recording for everyone who's shown up late or who isn't able to catch it live. So as you guys know, I'm Jordan from the Prudent Plastic Surgeon, and I'm joined here by Julian Vogel, who is the managing partner at Colony Hills Capital. And so the way I sort of got introduced to Colony was really fortuitous because I met their CEO, Glenn Hansen, at the Best Ever conference. We both happened to just be early to a VIP event because we were both speaking there. And so we got to talking just about personal stuff and hit it off. And then I kind of learned what he was doing, which was really exciting. And it was interesting too, because the time of the conference was sort of when a lot of real estate not was in trouble, but a lot of the people who kind of got in over their head were in trouble. And so it was really refreshing to hear Glenn and then Julian talk about kind of their strategy and everything like that. So I thought it would be interesting and educational for everyone to sort of hear from them and how they're doing things, because again, I think real estate's a great avenue for investing. And while I do it actively mainly, most people are kind of looking for more of a passive approach. And in that, it really becomes about who you're working with. So I asked Julian to join and share his expertise and really kind of use Colony's most recent deal as sort of a case example of how they're going about things and their strategy and everything like that. So without further ado, Julian, I'll turn it over to you to kind of do that, and then we'll have some time for Q&A after.
Awesome.
And certainly, if there's questions that come up, anyone feel free to chime in. But Julian, take it away.
Wonderful. Thank you, Jordan. I appreciate it. So before I share my screen and talk about the presentation and the deal that we're acquiring in July, I'm sitting in Western Massachusetts, 3 kids and a wife. I work as the fund manager for Colony Hills Capital. So my responsibilities are to essentially orchestrate all of the debt and equity for each deal that we acquire, but also to determine the fund strategies for each of our funds, and then also oversee the raise of those funds and how they're allocated. So sounds like a lot of hats, but we have 19 team members, all of whom have 10 to 30 years experience, great chemistry, fantastic camaraderie. So a lot of support amongst the team. So I'll share my screen now and jump into this deal. And as Jordan said, this will be a good case study, and it's also a live active deal for us. So before getting into the deal, I'll talk about Colony. Colony Hills Capital was founded in 2008, as Jordan Frey, Glenn Hansen mentioned. Glenn Hansen is the CEO, but he's also the founder. And the company started out as a family office venture for Glenn Hansen. And he's a very important piece of the puzzle for Colony because of the leadership and the business acumen he brings to the table. He started off his career when he was 19. He and his brother took over their father's tool and die shop, essentially like a small manufacturing business. And they grew it from 15 employees to 400 employees by the early 90s. And then they sold it to an institutional buyer. And that was Glenn's first liquidity event. But what was impressive about it is over about a 20-year span, a little over 20 years, the business lessons and strategies that he learned how to grow a business, obviously he kept with him. And then he moved from there into venture capital, and he would take an active role in all of his investments. So he has actually seeded and taken an active role in 25 different venture capital investments, Colony Hills only being one of them. But in 2008, right after Colony started, crisis hit a few months later, and he rolled up those companies and decided to solely focus on Colony Hills. And Colony Hills We are squarely focused on value add multifamily real estate, garden style multifamily real estate. It's headquartered in Western Massachusetts, but most of our deals have been in the Southeast and in Texas. We're also starting to creep into the Northeast and the Midwest. And to date, we've done over $1 billion in total capitalization, over 11,000 units. And a lot of that growth has taken place in the last 4 years because Glenn and David made a strategic decision to grow the company, grow the team. So I was one of those hires in 2019. And I've been doing, my job description has not changed in the last 4 years. And it's been an amazing ride in the last 4 years. And then before I just jump into the deal, one more thing on our strategy overall. 99% of our deal flow is off-market opportunities. These are sprawling garden-style apartment communities, class B to A minus, 20 years old, or newer, or a little bit older, depending on the opportunity. And we're primarily focused on growth, secondary and primary markets. We have an approach for all of our underwriting. So we're not just looking at the real estate itself. We're looking at the market and what the economic drivers are in that market. Are they downturn resilient drivers? What's the average median income of households in a 1, 3, 5 years around our property? Where has the property been? Where can we take it? What do the comps look like? What's the crime? What's the demographic trajectory in that trajectory, in that submarket? So that's how we analyze a deal. And then we'll typically hold a deal for 2 to 3 years. We'll underwrite for a 5-year hold. But once we've taken a property through our business plan, which usually takes 2 to 3 years, we'll typically sell the property through a marketed process. And to date, on deals taken full cycle, we've had an average levered IRR of 36%. So a number we're very proud of and took a lot of blood and sweat. So jumping into the deal itself, this is a very unique opportunity. And the primary value driver here is actually the joint venture that's selling the deal. This is a JV between KRE, Kushner, and Goldman Sachs. And they bought this deal 5 years ago. It's a 1970s vintage property, but they put $12.8 million into the asset. And just when they started to begin the renovation process of the interior units, COVID struck. And halfway through, they didn't stop the renovations, but halfway through those renovations, Goldman self-imposed a moratorium on rental rate increases and evictions. So basically what that means is they self-imposed a restriction on any rental rate increases, period. And that they did that right after KRE had executed, $12.8 million of renovations. So it sort of shot this joint venture in the foot. And they had renovated 85% of the units, spent $23,000 a unit, did all new sidings to the property, brand new roof, and then weren't able to increase rents because of that moratorium. Our CIO, David Kaufman, was able to connect to the senior asset manager at the selling company and get this deal off market. Just before it was going to be marketed widely or broadly, I believe it was going to be marketed through Cushman & Wakefield. And we are currently under contract for $115 million, and the property just appraised at $121 million. It's a going-in cap rate of 5.5%, which is very high these days. And by year 2, that same cap rate is 7.5% after we've actualized all of the dormant cash flow. So our plan is to renovate the other 15% of the units, which equates to 67 units. And I'm going to get into pictures and renderings further, but the other big part of our business plan is to redevelop the clubhouse. And basically with those two value adds, renovating the remaining units and then redeveloping the clubhouse, we'll have the nicest property within this vintage in the submarket. Here's some pictures of the asset. You can tell it's a beautiful property. Clearly money has been spent on it. And just a moment here on Princeton itself. This is the property. It's called Addison at Princeton Meadows. Average housing, according to Realtor.com, just shy of 700,000 in the area, but more usually $1 million. And you can see the average incomes, family incomes around the Addison are very strong. Highly educated population. Square in the middle between New York and Philadelphia. Easy, probably hour and a half drive to either. A lot of people commute. But then within Princeton itself / Plainsboro, there's obviously Princeton University. There's plenty of financial services. BlackRock has a satellite office there. Carnegie Center is a well-known hospital. You can see Siemens, a lot of household names. And I'm not going to dive into the details over here. Anyone listening, please feel free to request this package and you guys can dive into the grand details, but I'm going to just stay high level on, why we like the opportunity. And here's a list of the historical CapEx that the seller spent. You can see they spent $8.5 million on unit renovations. So really you saw those pictures before. It looks like the model unit, but really all of the 85% of those units look that way. And they're $100 below, all of the comps in the market. So there's tremendous, what's called loss to lease. There's a tremendous opportunity to raise rents and not revolutionize the rents, but just bring them to what the market's already bearing. And here's our CapEx plan. Obviously, two biggest ticket items is the $2 million redevelopment. We also plan on building garages, and we'll also be repairing a lot of the driveway, a lot of the parking lots and the asphalt. And we are actually adopting approved plans and renderings from the seller for this new clubhouse. One of the additional opportunities here with this deal is it's extremely difficult to develop in Plainsboro and Princeton, which is why there's such a dearth of supply of housing. It's a homes community, as we saw before, $1 million houses, not a ton of opportunity to rent. And so the average occupancy in the submarket is 95% plus. And here's an aerial view of our rental comps. So here's our subject property. Quail Ridge Apartments is a sister property. It was developed by the same developer. The Crest at Princeton Meadows was as well. And you can see the discrepancy between primarily our 1 and 2 bedroom rents and our comps. And many of these comps, with the exception of 2, right, haven't been renovated. And so the opportunity, as you learn more, it's glaring. It's a glaring opportunity. So currently, rents are for a studio. There's literally only one studio, so we probably shouldn't have had this here. But for a 1 bedroom, 1,700, we'll be taking it to 2,050, excuse me. For 2 bedrooms, about 2,100, we'll be taking it to 2,575. Scrolling back to that aerial, you can see some of our comps, 2 bedrooms. We're still not going to be leading the market, right? But we'll just capture what's called the loss to lease. And our sources and uses. So starting with the uses, we will be buying the property, as I said, for 115 million. CapEx budget, 8.6 million. Closing costs and reserves, 7.2 million. Part of our closing costs and reserves is a $2 million reserve for distributions to the GP equity. I'm going to get into the details of the joint venture structure in a moment, but this essentially will help to provide yield to investors for the first year and a half until the property has gone through the full value add process, and then the cash flow is organically, throwing off distributions. And then for senior debt, we're using Freddie Mac, 10-year fixed rate term, about 67% leverage. And then our joint venture partner, or our LP equity, is coming from a group called Peaceable Capital, former GE Capital guys. This is our third deal with this group. And on the other 2 that we own with them, they've been phenomenal to work with. That's a huge piece, obviously, of being in this industry, is finding groups who you can do programmatic deals with, who are good people, who are looking for solutions and not problems. That's definitely Peaceable Capital. And then the GP equity is 19.6 million. And within this 19.6 million, this is actually what we're offering right now. So the offering is a co-GP position. And out of that 19.6 million, Colony is bringing 8 million. So we were raising 11.6. Right now we have open about $3 million. We have the capacity to close the deal if we need to tomorrow, but we're very much interested in growing and broadening our investor base. And so there's roughly 3 million open right now. And the projected returns for that position, based on a 5-year hold, is a 24.75% IRR, or a 2.77 equity multiple. So you put in, let's say, 100K, you walk out with 277,000. That's forecasted. Nothing's guaranteed, obviously. And then the average yield projected is 8.23%. So in my opinion, and I'm sure from what you guys have seen, very juicy looking returns. Most of that comes from not only our structure, but also the fact that this is a co-GP position, but then furthermore that we're buying this at a 5.5 cap with so much dormant value. And then we could turn around and sell it in year 2, year 3 at maybe a 4.75 cap, and this 24.75% looks more like a 35. So we're very excited about this deal. We really feel like it's a unicorn. We're not seeing a lot of opportunities like this out there. Getting into some of the details of the debt, it's a fixed rate term at 5.39%, 6 years of interest only. And the cash flow, the way the cash flow is distributed during the ownership period, first, the LP equity Peaceable Capital gets a 8.5% prior to return on their equity. The next tranche of cash flow, this is during the ownership period, gets paid to the GP equity on their equity till an 8.5%. And thereafter, the GP gets a 60% promote off of Peaceable's position. So that means that 60% of what would otherwise go to Peaceable Capital instead goes to the GP equity during ownership after those 2 first stages. On sale, this is what's called the waterfall. First, the senior debt is paid back. Then this is all happening instantaneously, right? Then the first tranche of capital goes to Peaceable until they hit a 12.5, then to the GP until they hit a 12.5 IRR. And then we get a very significant promote. That 19.6 million gets a 60% promote off of Peaceable's money until they hit a 15 IRR. So what that means is let's say $10 million would have gone to Peaceable after these first two stages. Instead, they only get 4 million, and 6 million goes to the GP equity. And thereafter, it's a 75-25. For the co-GP position, this $19.6 million that we're offering 3 million for, Colony Hills Capital itself gets a 15% promote once all of the GP members have achieved at least a 10 IRR. So once all members have achieved a 10 IRR, then all sale proceeds are split 85-15, 85 to all the GP members, 15 to Colony Hills Capital. And that's our carried interest. That's, you know, our reward for having sourced and orchestrated the deal, asset managed it to success, and then, you know, of course, selling it for a success. And then lastly, here's a schedule of yield and returns for that 11.6 that I mentioned before, which is now 3 million because we've raised a significant amount of it. So for the first year, that 11.6 is forecasted to earn a 3.4%. Next year, 6%. Third year, 11.9%. And you where really the cash flow pops, where we've now taken the full rent roll through, we've marked the full rent roll to mark to market, meaning on new leases, we've increased rents by $300, $400. And the reason why it dips from year 3 to year 4 is because this $2 million distribution reserve runs dry at the beginning of year 3. And so this year 3 yield is a combination of the cash flow from the property, but also the remaining amount left in that $2 million distribution reserve. So by year 4, it's just pure cash flow from the property. And then you can see it jumps to 10.1% with then the sale yielding the 11.6, a $27 million distribution. And so that's in a nutshell how we come to these net returns of that 24.75 and the 277. And then this yield schedule, if you average it out, it equals 8.23%. So with that, I'm happy to take any questions. I'll keep the screen up in case anyone has any specific questions about anything I've said.
Yeah, thanks, Julian. I think that was really, it's kind of helpful to see behind the scenes how this stuff comes together. And then obviously as an investor, kind of the things that you're looking at. What kind of advice, and this is a broad question, but for, you know, people who are new to syndications, people who are just looking at this stuff for the first time, what are sort of the key questions to ask? Because there are, you know, more and more, there was even more before we were talking about this, but there seems to be more and more people coming with these opportunities. And I think, you know, the reason I obviously brought you guys on is because you have a long track record, and all of you within Colony Hills have a lot of experience with this. But that's not always the case. So what are sort of the important things for people to ask as they're looking at a deal as an investor?
So the first two things I would think about if I'm looking to allocate money with another sponsor, right? I'll just wear that investor hat for a moment. First, I'm going to look at the sponsor's track record and experience. How many deals have they taken full cycle? Who's the team made up of, right? Because that's ultimately who I'm trusting with my money. That's number one. And number two, what sort of asset type are they focused on? If it's multifamily, so then I'm getting comfortable with multifamily as an asset type, and it's pretty Googleable, the merits of investing in multifamily, right? Everyone always needs a place to sleep. They always need a roof over their heads. Average occupancy really doesn't dip within multifamily when there's a downturn, or when the market's doing well. It's very stable and consistent. especially sort of middle market housing from B- to A-. That's very difficult to build. And there's also a dearth of supply across the country for housing. So that's the second thing I'm thinking about. And then the third piece I'm thinking about is what market are they investing in? Is that market resilient? Is it strong? If the economy erupts tomorrow, will the industries that support that market also erupt, or will they still be here? So things like medical, education, distributions, which is like industrial distributions, um, things like that, they are resilient. People always need them. So those are really the main three things I'm looking at. And then of course, I'm then looking at the real estate itself, the actual property. What's the structure? What's the projected returns? What am I am I buying it at? What sort of cap rate am I buying or investing into? And where are they taking it? So those are sort of the 4-step process.
Yeah, I think those are all really, really good points. And it really does become, who you're investing with and their experience. And obviously, we've with any investment, you always say, well, the past doesn't predict the future. And that's true with anything because we're always in limited control, but you want someone who has more experience dealing with the ups and downs. And again, sort of when we saw that housing market rise, it did seem a little bit like everyone and their mother was sort of, becoming a sponsor for a deal. And we've seen as things have, you know, declined and we've seen how that's affected those who didn't have as much experience versus those who did. So how have you seen the market currently? It almost seems like the market now is a little bit advantageous for those who do have a lot of experience because you're picking up these distressed deals and able to kind of turn them around smartly. So how have you seen things evolving?
So a lot of sponsors are in hot water right now because they bought deals at very poor bases or low cap rates a year or 2 years ago because interest rates were so low. And so when they used the debt that was so inexpensive to acquire these properties, they can pay a much higher price. And now that interest rates have skyrocketed and a lot of those loans were floating rate loans, right? So those same properties are now being strangled by the debt service. The amount their mortgages that they have to pay are super high. And then if they're looking to refinance, unfortunately, the loan amount is also too high to take out. So that's terrible news for a lot of sponsors, a lot of owner operators, but it's unfortunate. It's fortunately good news for other owner operators because ultimately they'll be able to swoop in and sort of buy those properties in distressed states, not literally states, but distressed properties at a discount. So a lot of money right now is being pent up, waiting for that opportunity to occur. Um, we are we just about finished raising our second co-GP fund, and we're certainly saving and thinking about saving some liquidity for that event. But now still there's a gaping valley between buyer and seller mentality. A lot of sellers are still thinking that they can get prices that they could have got a year and a half ago or 2 years ago. And a lot of buyers are saying, hey, I don't have to pay that anymore. So it's interesting.
Yeah, I think that's you brought up a lot of good points. And I think the one with the floating or an adjustable rate mortgage is important. And certainly if you're looking into deals, talking about how that's set up, because people got really burned because they got the rates so low. And you kind of I guess in the moment you always are thinking optimistically, but you have to think realistically and go, okay, if rates are at a historic low, which way are they likely to go in the future? If my rate is re-annualizing, every year, well, probably it's going to go up. So we should underwrite our numbers. based on some higher rates. That wasn't done, and then a lot of people are finding that they just can't pay the debt off, which is obviously hot water, like you said.
Right. Yeah. The other really important pivot I think sponsors and we made, and I think other sponsors should make, is obviously to be using low leveraged fixed rate debt to avoid that from happening again, right? From being in that
Mhm.
situation again.
Yeah, absolutely. And it does tend with these deals, there's sort of like a lot of different return rates, etc., thrown around. For someone who's again looking at a deal and trying to kind of cut to the core of it, for you, what's the number one number to pay attention to? Is it IRR? If so, can you kind of explain that more, or what do you look at as sort of the biggest indicator when someone's going, okay, I'm gonna give X amount of money, what can I expect in return?
So the most important variable, it depends on the person really. So if a person is looking for income or yield, right, then they should be paying attention to their cash on cash or the average yield. If another person isn't as interested as income and really wants to grow their investment and grow their wealth or capital growth strategy, then they should be focused on the multiple, because the IRR can be um, it can be misleading, right? Because you can have a very high IRR, but it could be a short-term hold. But so you could have a deal that's going to throw off a 22 or 23% IRR, and it's underwritten for a 2-year hold, but it's only a 1.8 multiple, which isn't a bad multiple, right? But you would expect a higher multiple with such a high IRR. So it's when you pay attention to the multiple, you really get to the bottom line of what to expect as far as returns.
Yeah, and I think you hit on kind of what I was hoping, which is the IRR at times um, can be misleading, and not necessarily intentionally so. I think there are cases where it can be manipulated, but can you go a little bit more in depth of what encompasses that number and sort of the things that affect it versus the multiple?
Sure. So the IRR, in order to forecast, is actually a pretty complicated formula. On Excel, it's pretty simple though, right? Made easy. Um, IRR in retrospect is really easy to understand, meaning once you sold the deal and you look back on what your IRR was. Why? Because IRR is simply an average. It's an average of, it's taking all of the distributions you've received, your return of capital, your share of the sale proceeds, aggregating it into one number. And then the IRR is essentially taking that one number and spreading it out over your hold period as if you had gotten those distributions every single year. So let's just say you made $1 million on an investment and you only got year one, you got paid 100,000. Year two, you got 150. Year three, you got 200. Year four, you got 200 again, but then you got a bunch of, you got your share of the sale proceeds. So you look back and you have $1 million. What's my IRR? My IRR tells me if I were to take that $1 million and spread it out over a 4-year hold, it was as if I got 250,000 each year. So that's how the IRR is equated. So it's tied to time. It's tied to time and your average return on a per annum basis.
Yeah,
I
and
don't
then
know
the
if that made
multiple.
sense. I hope I articulated it well. It's a pretty
Yeah, yeah, because it basically gets averaged out, and then the multiple essentially is just much more simple, and
much more
yeah.
simple. It's just taking, hey, I put in 100,000 into this deal with distributions aggregated plus my share of the sale proceeds. What's that aggregate number? Let's just say it's 250,000. Okay, I got a 2.5 multiple, right? I put in 100, I got out 250.
Yeah, and so that's where again, if it's a short hold on the property, if you're dividing by a smaller number, you can start getting these IRRs that seem really large. but it's not, because again, your money's only in the deal for a short amount of time, so it's not multiplying as much. So that's anytime you see a really, really big IRR, you just kind of want to ask about that. And again, not saying the multiple can be fine, but you have to understand it's for a short period, and the shorter period you're holding anything, in general, the more chances, let's say, for something to go wrong, with I don't know if you agree with that, Julian, but essentially, with real estate, the same as like the stock market, the longer you hold, things trend up. There can be short-term fluctuations, but over the long term, these have been pretty stable things. So that's why buying and holding, tends to be the predominant strategy.
Sure, I would agree with what you just said. I'd also say always different situations, depends on,
Sure.
what you're buying at what basis. Um, of course.
Yeah. And certainly if anyone has any other questions, feel free to just jump in, or if you just want to put them in the chat and I can read them out. But the next thing, Julian, I wanted to just ask you to briefly go into is sort of the tax advantages that also can be taken advantage of with investing in these private deals. That's something certainly everyone's trying to minimize their taxes legally, obviously, and real estate's it has a lot of advantages in that, but they tend to sometimes get misconstrued or mixed around. So maybe you can highlight those.
Happy to. So when we buy a property, we perform what's called a cost segregation study on the property. We don't perform it. We actually hire a third party engineering service to perform it. And what they do is they essentially come to the property and they break the property up into theoretical parts, and they give a lifespan per part. So let's say they give the roofs a 15-year lifespan, they give HVAC a 7-year lifespan or a 10-year lifespan. They give the sprinkler system whatever lifespan, right? So they break it up into different parts. And what that enables the owner or operator to do, meaning us or any other group that has this study performed, is it allows depreciation to go on steroids, hyper depreciation. And what that does is that causes your year one and your year two loss to be very significant, your tax loss, because depreciation is a theoretical expense. It's an unrealized expense. And so when you have this cost segregation study performed, let's say your year one depreciation caused you to have 100% loss on your investment. So you put in 100K and you had a loss of 100,000. But hey, I got distributions each quarter of $5,000 or $10,000, whatever it was. You can then apply that loss, that $100,000 loss, against the distributions that you've received. So now those distributions are not taxable income. They were 100% tax-free. And then that additional loss that you still have, you can either choose to accrue it for the lifespan of the property that you own it, or you can apply that loss to other passive income, meaning other investments that you have that are throwing off income. You can apply that loss to it to reduce or neutralize your taxable income for all of those investments. So that's during the ownership period. And then if you have a deal where it's not throwing off a ton of distributions and it's more of a back-ended sort of return, you can then accrue all of that loss and then apply it to your capital gains when you sell the deal, so that you could either neutralize or significantly reduce the amount of capital gains you'd have to pay when you actually sell that asset and receive all the sale distributions. So those are the main tax advantages Colony Hills uses. Other sponsors also utilize the infamous, in a positive way, 1031 exchange. We've found that very complicated to make work with our process. So it just hasn't worked for our investors. But like I said, we've been able to leverage depreciation pretty nicely. And then the last opportunity is what's called a DST, a Delaware Statutory Trust. And that's basically a trust that's set up where all of these different investors, if they all had capital events and they all have this these sale proceeds and they want to do a 1031, but they can't find a property to put that 1031 money into, they can put it into a DST, and basically all of these 1031 investors get pooled together to then invest into one asset. So there's a lot of different ways to skin the cat, so to speak, to leverage real estate from a tax perspective.
Yeah, I think that's all really great. And the depreciation, I think, becomes like a really nice one, especially for doctors, because those passive losses can carry forward. So if you don't use them in the year, you just carry them forward. And then a lot of physicians are towards the end of their career, either selling a practice or having some other type of large capital gain event, and you can stack those passive losses to help offset those gains, which really becomes huge, because when you're talking about a sale of a practice or something, it's you know, sizable. So that's a huge advantage from this, because a lot of people, what attracts them to active investing in real estate is the idea of collecting that depreciation, those passive losses, and then offsetting active income. That requires obtaining real estate professional status, which is something my wife has, but that takes a lot of work. And once people figure out how much work is involved, they tend to be a little bit less enthused. Not that it's not great and can be worth it, but with opportunities like these, you're completely passive, and you're also able to, depending on your, you know, career stage and what you're planning to do as you reach that retirement age, able to kind of plan for things appropriately, where you're making money along the way, but also collecting paper losses. So it's kind of a win-win.
Yeah, I mean, this is why family offices love real estate, right? Because they have their own business ventures, which is how they got family office status, and then they can use real estate to neutralize the taxes they owe from the business. So
Yeah. Awesome. Well, we've reached the 45-minute mark, and I want to be respectful of everyone's time, including you, Julian, which I really appreciate you taking some time out of your day to go over this and educate all of us. I know I learned a ton, and really cool kind of seeing behind the curtain. So thank you so much. Everyone that joined live, thank you. And I'll be sending out the recording later tonight, along with some additional information. So thanks again, Julian.
my pleasure. If anyone has any questions, if they're interested in the opportunity, if any of the concepts went over anyone's head or under anyone's head, I'm happy to get on a one-on-one phone call or answer any specific questions.
And I'll make
Really
sure I'll put a
appreciate it.
link when I send the replay out. But what's the best way for people to get in touch with you if they're interested?
Email.
Okay. All right.
Yeah,
Perfect.
email
What's
is
the email?
perfect. Julian, so it's my name right there. Julian, Julian, .Vogel, Vogel, at colonyhillscapital.com.
Awesome. All right. Thanks, Julian. Thanks, everyone. We'll see you later.
Thank you.